Okay, this is a video explaining how to prepare a set of financial statements. That is an income statement, a balance sheet, and a statement of cash flows from a trial balance. This will be part of test one, so you should be very familiar with this. The students who came to Wednesday's class already saw this, but if you want to look at it again, that's great. If you did not attend Wednesday's class, I strongly recommend that you watch this. Okay, so first of all, we're going to start off with showing you where the information you need to go along with this video is. There it is. Okay, so you will find all the information you need for this video to go along with this video right here on the Canvas webpage. You do need the handout to go along so you can follow along. So what this is a completed copy. This is the result that we're going to get. And you can follow along where I'm getting the numbers using this. There's also a PowerPoint slide presentation that tells you the rules of current assets and current liabilities. You are going to have to memorize this. So open that up and look at it first when we get to the statement of cash flows. You can either download it now and open it up, or you can stop the video when we get to the statement of cash flows and read it. So it's right on the webpage, and this video will also be right here. Okay, so in front of you, you see a trial balance. We've talked about trial balance extensively in this class. First thing you want to note is that the debits equal the credits. You also might want to note that we have 2 years. We need 2 years worth of trial balances to complete the statement of cash flows. So the income statement and balance sheet will be using just this information. Just this information. Just this information. But when we prepare the statement of cash flows, we're going to need both years. Okay, so let's get started. First of all, we start off with an income statement. Remember I said that we have to have a heading in the income statement. So the company name has to be on top, then what it is, and for what period it's covering. Remember, the income statement is a flow statement. An income statement shows what happened over a period of time. In this case, 1 year. We also said that an income statement always starts with revenues. So what we're going to do is we're going to use this part of the trial balance to prepare the income statement. So the income statement of the 5 elements of accounting, the income statement assets, liabilities, stockholders' equity, revenue, and expenses. The income statement uses two of those, revenues and expenses only. So we have highlighted the revenues and expenses on the trial balance. We also said that when you have product revenue, you also have to show the related cost of goods sold. So we're going to do it this way. And we're going to use this number. Cost of goods sold, we're going to use this number. And I'm going to put it in brackets just to indicate that it's a subtraction. Now I simply took this number, the 850, and subtracted 700,000 from it to get the 150. So 850 minus 700,000 is the 150. Then I'm going to add the other types of revenue we have. So this company has two types of revenues, product revenues and consulting revenues. It doesn't need to be shown this way, but you do need to show, remember, whenever you sell product, you need to show the gross profit, and you also need to show the total revenues. So I'm accomplishing that in this little exercise. Consulting revenues were 650. Got that right off the trial balance. Now, the reason I did this was because now the user can tell how much revenue we had. They can also see the gross profit on product sales. And then the last line is revenues from product sales and consulting services. Then I just combine these two numbers. This is one way to do it. So I just added the 150 and the 650 and came up with the 800. Okay, so now we're going to do operating expenses. Now we don't take cost of goods sold, the first expense, because we already used it here. So we start with the second expense, which is consulting employees' wages. And what I usually do is I usually just go down in order. Again, there's no rule here. You can put it in alphabetical order if you want, in size order, whatever you want. I do it in order of the trial balance. That just seems to be the easiest way for me to do it. So I start with consulting employees' wages. That's $300,000. And I go to the next item, which is rent expense. Then I go to the next item, management salaries expense. Then I go to the next item, administrative expenses. Then I go to the next expense called depreciation expense. And then I go to the final one, interest expense. Okay, like we said in class, you can combine these things. They don't have to be shown like this, or you can combine the total and put total operating expenses. The key is you must have a line that says total operating expenses. I put it in capital letter. Well, the key here is you have to have a heading that says operating expenses, and you have to have a total. So what I would do now is I would just add up these numbers. 300 plus 200 is 500. And I already know this is another 100. So total operating expenses is 600,000. And then you subtract this line, the 800,000, from the 600,000. You could show this in brackets if you want. Just going to do it for demonstration purposes. And you get 200,000 as net revenue, net income. Now you go to the balance sheet. A balance sheet also has the company name, a heading, company name, what it is, and the balance sheet is a snapshot. It's the financial position of a company at a specific time. So it's as of some date. The balance sheet shows the other elements in the accounting equation, the assets, the liabilities, and the stockholders' equity. But we've accounted for all 5 types of elements. And as you know, the accounting equation is assets The basic accounting equation is assets equal liabilities plus stockholders' equity, and that's basically um, what the balance sheet shows. So now we're going to use the top portion of the trial balance from here down to here. We start with the assets. We start with current assets. Current assets are just those assets that are going to be turned to cash within 1 year. So cash obviously is cash. First, you need a caption called current assets. And then you start listing them. First one is cash. I go up to my trial balance. My cash balance is 80,000 cash. I want to use the 2019 numbers. It's 80,000. The next one is accounts receivable. We're going to talk more about current assets and what they are a little later. And I'm going to use 320,000. Accounts receivable, 320,000. And the last one is inventory. So what they're saying is that these current assets are going to be converted into cash within 1 year. So essentially, I'm going to collect all the amounts that are owed to me today within 1 year. As I said in class, usually the terms are 30 days. So that's a reasonable expectation. I'm also going to turn my inventory that I have today. I'm going to complete, I'm expecting to sell all my inventory as of that I have on today. So that's also why it's a current asset. And I'm going to use 800,000. I'm going to add all these up. 80 plus 320 is 400, plus 800 is 1,200,000. So you must have the heading, the company name, what it is, and as of date. There must be a heading called assets, and then there must be also a heading called current assets. And there must be a total current asset line. The reason for this is because some investors use current assets as part of their analysis of whether or not they're going to invest in a company or not. The next area is property, plant, and equipment. It always goes second. Property, plant, and equipment could also be called machinery and equipment. Anything that pertains to fixed assets, assets that are going to have a life longer than 1 year. Remember, current assets really only have a life of 1 year. These assets have a life of longer than 1 year. So you would expect machinery and equipment and computer equipment to last longer than 1 year. So the machinery and equipment value is $600,000. The value of the computer equipment that I have is 100,000. Now I need to show the total property, plant, and equipment at cost. You can show this in your footnotes, which we have not talked about yet, So that's why I'm doing it here. I need to show the investor, the user of the financial statement, how much I've spent in total cost on property, plant, and equipment. And then we say depreciation. Now, you're going to learn later that depreciation is just simply wear and tear on the fixed asset. So just like your car, parts on your car wear and tear, parts on the machinery and equipment have wear and tear. And so does computer equipment. Depreciation is the capturing of that wear and tear. I can add these together, the 57 and the 10. So accumulated depreciation, machinery and equipment is 57. Accumulated depreciation, computer equipment is 10. So I can add those together and get 67. So the 67.5 simply comes from this 57.5 plus this 10.5, 10. Here and here. Since it says less, I'm going to subtract from the 700,000 the amount of depreciation and get 632.5. Okay, land is not depreciable. So the last part of the asset section is other assets like land. You're going to learn about goodwill, those kind of things all go in other assets. Since I only have one other asset in this case, I don't have to put the caption other asset. Land is valued at $300,000. The value of land does not go down. Now I'm going to add this number up to this number plus this number, and I'm going to get a total assets. So 1,200,000 plus 632,500 plus 300,000 equals 2,132,500. I'm not sure if you saw that or not, so I told you the numbers that I was getting. So here's what the top section of the asset section of a balance sheet looks like. Now we're going to complete the liabilities and the stockholders' equity section, the right side of the basic accounting equation. We start with current liabilities. Current liabilities are simply the opposite of current assets. Current liabilities are those liabilities that I'm going to pay within 1 year, that I'm expected to pay within 1 year. So all of these, my employees are going to want their salaries within 1 year. My vendors are going to want payment for the product that they sent me for 1 year. And I also have 12 months worth of notes that I have to pay. So this is the next 12 months worth of note payments. So I start with accounts payable. I then go to salaries payable. And yes, those two can be combined if you want, but I'm going to break them out just for demonstration purposes. And then the last one is the short-term portion of the note that I have to pay. So that's the next 12 payments that I have to make on this bank loan. And now I'm going to add these numbers up. So I'm going to add the 150, in case you can't see the calculator up here, plus the 82.5, plus the 60,000, gives me 292,500. Now, the next section is long-term liabilities. Those are liabilities that I'm expected to have longer than 1 year. I'm not going to be able to pay off the long-term portion of the rest of this note in 1 year. I'm going to have 5 or 10 years or 15 years or 20 years to pay it. So this portion would be a long-term portion, the portion that extends out greater than 1 year. So I'm simply going to take this amount. Now we get down to the stockholders' equity section, which is the last part on the right side of the basic accounting equation. And we're going to look at retained earnings and capital stock. Does not matter. The order does not matter. I'm going to put capital stock first just because it shows up first on the trial balance. And I'm going to use the 400,000 that's shown right here. Next section is retained earnings. Okay, retained earnings is a little tricky. Remember that we closed the books. We have not closed December 31st, 2019. So as you can see, retained earnings is the same, but we made $200,000 in net income for this year, 2019. So we need to simply take the 500 that's showing now in the trial balance and add it to the 200, the net income for this year. So I'll do that again. You take the amount showing on the retained earnings, 500,000, and you add to that number the net income of 200,000. You add those two numbers together and you get 1,100,000. Then you add the current liabilities, the long-term liabilities, and the stockholders' equity section all together. So that's 292.5 plus 740,000 plus 1,100,000. And you get 2,132,500. Now you want to make sure that your liabilities and equity equal your assets. Total assets are 2,132,000. Total liabilities and stockholders' equity is 2,132,500. The last financial statement we're going to prepare is the statement of cash flows. The statement of cash flows, again, starts with a heading, the company name, what it is. And again, this is a flow period, just like the income of flow statement, just like the income statement. So it shows what happened to cash during a period of time. In this case, 1 year, January 1st, 2019 to December 31st, 2019. The statement of cash flow always starts with net income. You get net income simply from the income statement. So this number is the first step in the statement of cash flows. Now you have a second section. By the way, you also need a heading, cash flows from operating activities. The second section is adjustment to reconcile net income to cash provided by operating activities. What this is talking about is remember, this is on the accrual base, the income statement is on the accrual basis. We're turning the accrual basis into cash. What happened to cash? Depreciation expense, as I said, is an amount of wear and tear on equipment, but I don't pay a check for that. So that is called a non-cash expense. Since it didn't involve any cash and it was subtracted out of against revenues, see it's in this number, we took the 800,000 and subtracted the 600,000, of which the 14.5 of depreciation is included in. We have to add it back. Now, the third section is changes in current assets and current liabilities. So your current assets and current liabilities, remember, your current assets were your cash, your accounts receivable, and your inventory. Your current liabilities were accounts payable, salaries payable, and notes payable short term. You don't include cash in this analysis. So you start with accounts receivable. As you can see now we're going to go to the rule first. So I'm going to stop sharing. And we're going to go to our first rule. An increase in any individual current asset is a decrease in cash. You may or may not understand why right now, but you just got to accept that rule for now. A decrease in any individual current asset is an increase in cash. So if a current asset increases, it's a decrease in cash. If a current asset decreases, it's an increase in cash. So the first current asset that we're worried about that's not cash is accounts receivable. Accounts receivable went up. It was 250,000 at the end of 2018, and for the end of December, for the value of it for December 31st, 2019 is 320,000. So it went up 70,000. As we just said, an increase in a current asset is a decrease in cash. An increase in a current asset is a decrease in cash. This current asset increased from 250,000 to 320,000. The next one is inventory. Inventory went down from 950,000 to 800,000. A decrease in any individual current asset is an increase in cash. So since inventory decreased, that represents an increase in cash of 150,000. Now we go to the current liabilities. Remember, the current liabilities are accounts payable, salaries payable, and the notes. Note that the note didn't change. Let's go to our rule. An increase in any individual current liability is an increase in cash. A decrease in any individual current liability is a decrease in cash. So accounts payable shared this one. So let me do that again. So accounts payable went from 250,000 to 150,000. It decreased. It went from 250,000 on December 31st, 2018 to 150,000 on December 31st, 2019. What does our rule say? A decrease in any individual current liability is a decrease in cash. So cash decreased because accounts payable decreased. It went down $100,000. Salaries payable. Salaries payable went up from $7,000 in December 31st, 2018 to $82,005 on December 31st, 2019. What does our rule say? An increase in any individual current liability is an increase in cash. So this would be an increase in cash of 75,500. Salaries payable went from $7,000 to 82,005. Now, we don't include short-term notes because it did not change. The amount of the payments did not change from 2000, December 31st, 2018 to December 31st, 2019. Okay, so now we're gonna add these numbers up to get the cash provided used in operating, the net change in current assets and current liabilities. So in case you can't see this, so I have two negatives, 170,000. I'm sorry, I switched these around again. So now you just simply add down it's 55. Now you simply add down. Now you go to the investing activities. So investing activities are those activities where I purchase things that I'm going to be able to use in the future, that are going to benefit me in the future, like equipment. So we go up to our trial balance and we see that equipment, machinery and equipment went from 500,000 to 600,000. So that means that we spent $100,000 on equipment, which means that I paid out cash for equipment. So it's the purchase of machinery and equipment. And since I paid it out, that's a use of cash. So I get that by simply saying, looking at this, the trial balance, and seeing that machinery and equipment was $500,000 in 2018, but in 2019, it's $600,000. So I purchased an additional $100,000 worth of machinery and equipment. I also purchased an additional $20,000 worth of computer equipment. The next section, the last section, is financing. Remember, financing has to do with selling stock or taking out new loans. In this case, we take a look at a trial balance and we see that capital stock, that the long-term portion of the loan didn't change at all. So we didn't take out any new loans. But the capital stock did change. It went from 590,000 in December 31st, 2018. Now it's only 400,000. So we bought back our stock worth $190,000. Since we used cash to purchase our stock back, that's a use of cash. So now we take the 270,000 as a plus, we subtract out the 120,000, and we subtract out the 190,000, and we have a $40,000 decrease. Now we look at the beginning of the year. The beginning of the year is the end of the last year. So on December 31st, 2018, just like on January 1st, 2018, our cash balance was $120,000. Our cash balance today is $80,000. So if you take the 40,000 negative and you subtract that from the 120,000 positive, you get $80,000 positive. All right. That's all I have for you today. So I'm going to stop recording this. And thank you for paying attention.